Welcome back to the next repo video which I talked about. Now, I let things go for about a month. The reason being I wanted to make sure that this crisis in the repo market was not a anomaly that was part-time, and in fact sometimes I prefer to err on the side of caution. What I decided to do was to, like, there are a lot of videos out there on repos and things like that, but nobody's really explaining what the repo is and then going forward and describing what's happening in the repo market for the man in the street, as it were, not just Wall Street. So what I've decided to do is do a very quick definition of what are repos. Now, when you're considering the repos and what the negative effects of what's happening at the moment is, I want you to understand a bit about the whole concept of what's going on before we look at a more detailed explanation later on in this video. So there are two types of repos. There are repos and reverse repos. Now, a repo is where the institution borrows money from the lender of last resort, the Fed, and the reverse repo, as you can imagine then, is where the institution sends back its excess reserves back to the Fed and gets an interest rate for that, which is usually less than what it pays to receive the money as a lender, as a receiver of, as a lender of last resort from the Fed in itself. So this is to discourage misuse of the repo market by the banks, and usually you typically see like 1.8 repo rate, 1.6 reverse repo rate, just to give you an idea. Now, what these definitions are really important to understand what's going on as we progress further in the video. Now, another thing to try and understand is, why is the repo market so important? Well, first of all, the Fed is the lender of last resort, and what the Fed is doing is the Fed is effectively keeping the money system. Now note that I haven't said the banking system, I'm talking about the money system, the liquidity system, from basically jamming up. So it is of fundamental importance for the overall liquidity of the market that this repo market functions. Now, as I've said, it's a money system and it's a liquidity system, and it just isn't a banking system, although the banks are the major participants in that system. So you have other participants like mutual funds, hedge funds, investors, primary dealers. They all participate in the repo market. Effectively, where somebody needs cash but is allied or with the primary dealer, that's who gets it. Now, the whole point is, are there fault lines in the system? Of course there are. We wouldn't be seeing the current conundrum with the Fed and the pretend quantitative easing if there wasn't a problem in the system. Now, what I want you to do is, I want you to have a look at this next section of explanation as to what is going on in the repo market. So it's a fairly detailed section of an explanation, because what you tend to see with most commentators in the market is they just take a snapshot of the New York Fed repo market positions for the day, and they just say, oh, this is such and such and this is such and such. But what I'm doing in this section here, so bear with me, is to explain a lot of the history of what's happened in the repo market since this thing exploded. So if you bear with me and you actually look at this next section, you'll understand to a much greater extent what it is that I'm saying. And in particular, I want you to pay attention to what I say regarding the MBSs, because the mortgage-backed security section of illiquidity hasn't been picked up in the mainstream media as usual. Right, I want you to have a look at this repo history from the Federal Reserve Bank of New York, and it's quite important what I've been saying before as we scroll down on this here. Let's just go back, as I mentioned before regarding the definition of repos and reverse repos. What we can see going back to August, if we have a look, we can see reverse repo, we can see amounts submitted 13.0 billion. This ironically corresponds to the time when there was the August pivot, basically from the euro and other negative yielding interest rate sovereign bonds to the US dollar, and we've seen that because if you actually look, the further I go back, you can see that there hasn't been much huge activity as far as repos are concerned. It's all reverse repo, and this is important going forward. Look, reverse repo on August the 13th, reverse repo August the 14th, etc., 15. But notice that on August the 16th, the amount has actually gone up, and it keeps on going up. We can see 13.4 in reverse repo, but notice all reverse repos, and this is quite important as we go forward closer to the September hiccup, when the repo market basically imploded, in my view. But as you can see, everything is reverse repo. We do not see repo there, so there has been no demand by institutions for the federal funding of last resort. Now, let's go further on to have a look past Monday the 16th. We can see, again, still going through reverse repo, September 13, etc., same day. Notice the amounts aren't huge, 3.6 all in reverse repo. Now, what this means is, as far as the funding is concerned, that the banks were adequately liquid because they were returning back money to the Federal Reserve without actually borrowing money from the Federal Reserve as a lender of last resort. Now, if we now start and go, and we start looking at some different dates here, let's have a look. So we can see Friday, September 13th, reverse repo, and we can see that it's not a huge amount, 2.675. Monday, September 16th, all of a sudden, look, between Monday, September 16 and Tuesday, September 17, we see it go, excuse me, from reverse repo to repo. And it just went from basically 2.2 submitted to the Fed in a reverse repo sense. We now have the first repo starting. And what's important is look at the average weighted interest rates. And this is important later on in the slide that I'll show you about what's happened with these yields, etc. But look, mortgage-backed securities have come on, 11.7 for one day, 11.7 billion. They weren't even figuring in the calculations. Now let's go forward. September 17, we have a lesser amount on reverse repo, 1.8 billion being returned. And then on the September 18, we have 80.5 billion, of which 27.8 billion mortgage-backed security funding necessity for one business day. And we can see that's come in at some large amount. This is an extremely large figure, as I'm going to show you later on in the next few slides why this is significant, because this generally has been ignored by the market. Look, September 19, repo, 26.1 billion mortgage-backed securities, Treasury 56. We're talking about 30% of the total amount of Treasury amount that's been required. The collateral returned, 5 billion, nothing. 75.5, 15.3, 3 days over the weekend. We keep on going up. September 20, submitted, 7.5. Look at that, 65.75, 15.5. 1 day, and it's a 1 day security. So we're starting to look at something that's starting to eke its ugly head up as far as it's concerned. So a month ago, 62, 25.4, 20.8, 1 day. And there we have the largest day, September the 25th, on the repo days, 56.3, but nearly 35 billion in mortgage-backed securities, 35 billion submitted and only 29.6 accepted. So there was a lot of underfunding went on with the mortgage-backed securities. Look, underfunding, 29.25, 24.25. That was for 10 days, but still underfunding by about 5 billion. So we've seen one massive market hiccup. This is when the Fed started getting, oh, something's going on here. We can see that submitted 34.5, accepted 15.5, stop out 1.8 rates. This is where they've basically had to provide enough funding to keep this rate about 1.7, 1.8. Now remember, this is before the Fed on the 30th of October has reduced the interest rate by 0.25%. So it's been absolutely necessary to get this rate this rate as close to the short-term money between the 1 and 3 month bills basically as quickly as possible. Look at this. You see 13.7, 13.7. I really don't understand why the mainstream media and a lot of people haven't seen what's going on with this this repo side of things as far as the the operations are concerned, because mortgage-backed securities were one of the main triggers for the last massive Great Recession. Now, if we actually look going back further, we can see this is the proof basically that on September 17 you can see the 11.7 submitted. So really we have seen from this September 17 a massive change in the position of the health of the liquidity of the US financial system. Now if we go back to today and we start looking, have things got any better? We're talking about October the 31st. So reverse repo, 2.85 billion. So what's been the uptake today basically? Thursday, October 21, 8:30 a.m. 55.2, 17 and a quarter, 1 day. Remember, this is 1 day. So we've been looking at a very high demand on the mortgage-backed securities. And again, I'm absolutely astounded that this hasn't been picked up. 9 billion, 9 billion. Now, there wasn't even any demand for funding of mortgage-backed securities. Look, Tuesday, October 29, 20.25 billion. Right, okay, I know that's over 14 days, but we're still seeing a lot of money being rolled forward in the short terms. And look, the reverse repo, 0.036, nothing's been returned. So you can see that we are in a definite situation where there is a liquidity crunch. There are some pieces of background information that will make this puzzle a little bit more clear, but certainly the demand, as we can see on October 31 for 72 billion, is still very, very strong and out there for liquidity. Basically what it is the money markets are illiquid. There are a lot of problems in there. Now let me go forward to the next couple of slides that will show that we are indeed in a very dangerous liquidity situation going forward on this. So let's now look and take a more detailed look at the hidden MBS risks. In the following slide, we can see that MBS has took up 1.8 trillion, 1.77 trillion, but let's say 1.8 trillion of the 4 trillion balance sheet. So we can see that MBSs are a very, very important part of the whole rescue package that was in 2007, 8, 9. And remember, these MBS securities, these mortgage-backed securities at the time were called toxic assets. Now, it's always been a joke to me, how can something be an asset and be toxic? And yes, I suppose the literal balance sheet term is something's on that side of the balance sheet, it's an asset, but it's anything but. And it's come back to rear its ugly head, as you will understand and see in the remains of this video. So these are much more like toxic liabilities than assets, and you'll understand, as I said, why later on. So here's the irony. When the MBSs were in the period between 2008 2009, in the period 2008 2009 till the present stage, well, up before September, there was no demand for MBSs in the repo market. As you can see from the slide, you can basically see that there was a, how would you say, a hiatus. If you look at the MBS slide, you can see that from 2008 2009 we had multiple quarters of 20 trillion injected into the Fed balance sheet, and then back in September we see that there was a 7 trillion September of this year, completely flatlined. It flatlined. There was no demand, there was no anything. Then all of a sudden, September 2019, we see 7 trillion. So this is where the problem basically lies in many things going forward. What we can see is that there has been a marked, massive change in the market as far as MBS securities are concerned. In fact, as far as repos are concerned, there was nothing. But the reason why I've picked up on the MBS securities is that simply they were the toxic assets that were bought off the banks that caused the problems in the credit implosion that occurred back in 2008, 2009. Now, it's not that I necessarily believe that the MBS securities are going to cause the next calamitous event as far as the financial collapse is concerned. It's that these are a foretelling warning of what is actually coming in the system, and this is really important going forward. So not only are MBS securities making up 30 to 40% of all of the market, we're finding that the demand for MBS securities, as we've seen before when I went through the whole sheet from the New York Fed, this amount is getting actually very alarming, and it does portend much more deep-seated credit problems in the whole financial structure. Now, I want you to see the following slides, and the following slides basically are showing what the amount of MBSs that have been sold into the market that could be potentially causing this problem. You can see that on August the 23rd, the MBS securities was about 1.8 trillion, as we've alluded to before in the slide that I showed you, 1.8 of 4.0 trillion. But what we can see in the next slide is that between August the 23rd, 2017 and October the 23rd, 2019, it's about 1.5 trillion. Well, it's 1.46 trillion. This represents about 320 billion that has been injected back into the market. So we're talking about 10% of the total amount of the Fed balance sheet that was in MBSs. But what we're seeing with the demand for repos that are MBS related, we're seeing 10% of that 30-odd billion, 300 billion. So we're ranging anywhere from 7 billion to 25 to 28 billion to 32 billion. That is quite worrying in its extent. So if you look at this particular figure, what we can also see on the 7 billion, there was a spike. There was no MBS's repo requirements for 28, 29, and we are seeing that this repo situation is getting much worse. So what does this actually mean? Well, what it means is this, with what I was showing on a daily basis, what's happening in the repo market, what's happening in the demand of the MBSs, what's happening with the term increases in these repo requirements, what is happening in the fact that the reverse repos have almost died away, in other words, that the full amount of liquidity that's necessary is being used, we're talking about a major problem that is growing within the repo market, and it's not going away. Now, the fact that the Fed is providing up to 120 billion of extra funding, they're not calling it QE, we can see that at the height of QE, we were talking 60 to 80 billion of QE. We're even past that now, and it's not called QE. So what we're finding is that if you actually even look at the yield curves of the 1, 2, 3 month up to 1 year on the US Treasuries, we can see that this is being reflected in the short date Treasuries, where the Fed is really trying as much as possible to keep this liquidity rate low, between 1.6 and the interest rate low in this short-term period between 1.6 and 1.8%. So they have to do this. If they don't do this, what we're going to find is that there's just going to be no room to move as far as the Fed's concerned in lessening rates. So this is being reflected with they've brought the Fed rate down via the repo market, having to inject a massive amount of liquidity just to be able to keep the actual rates lower and try and reinvert the yield curve. Now, why is this repo market doing this at the moment? Well, my theory is that it basically is to do with the counterparty risk, and there's a major collateral risk out there. And let's face it, if, as I said, these MBSs that have been sold into the market are of much more toxic variety, it doesn't matter about the yields. What we're finding is that this MBS collateral is not being accepted by the primary dealers. So what's happening is the Fed, as a last resort, has to come in and reliquefy this side of things. So this is quite a danger. Now, this particular chart that we're showing here is, again, basically, it's basically confirming what my worst fears are as far as this MBS side of things is. You can see that the composition of the SOMA domestic securities, we can see that it's 50-50 almost between the agency MBSs and the Treasury securities. And just look how it's just tailed off, but it's tailed off proportionally in 2019, yet it was flat and higher from 2017 odds. So we've had a major change in the collateral, in my view, in the collateral risk appreciation in the short-term money market. So there's definitely somebody or some major institution out there that is having problems and is continuing to have problems. Now this next clip, again, this is from the New York Fed. Look, the blue line. The blue line is, and look at the spike. Look at the spike around to 2019. That massive demand for liquidity in MBOs, and look how it's gone up. It's just skyrocketed compared to agency treasuries and the US treasuries and equities. It's absolutely skyrocketed. So there is a major problem there. I'm really surprised that the mainstream media hasn't picked up on this. And there's more to come in this in my next video as to which and how institutions are faring in regarding this. And there's a little bit more deep-seated anxiety in the market that's actually being made apparent. But what I wanted you to see in this video was that there is a lot of things going under the surface, and it's not just treasuries. Treasuries are, in inverted commas, riskless as far as the US government is concerned, but it does have risk. But the MBS securities that are being financed and the amount of them is a major concern going forward. And I'm going to, as I say in the next video, look in a bit more detail in some things that are going on with the institutions and the regulatory authorities that's influencing this market, and I think you should be aware of. Thank you for watching the video, and I look forward to the next one. Thank you, and bye.